All right, let's get straight to it. The U.S. markets are closed for the weekend. It's Saturday, November 15th, 2025. We need to look at where Tilray Brands, ticker TLRY, finished the week because it tells a critical story. The stock closed Friday's main session at 1.08 USD. That was a rough day, down 4.42% or 5 cents on the share. But the selling didn't stop there. In the after-hours session, it trickled down even further, losing another cent to sit at 1.07. Now, the immediate expectation when you see a price like 1.08 is failure. It's a stock that has been decimated, a shadow of its former self, and many investors see this as a company on the brink of being delisted. The reality, however, is far more complex. This price level represents a critical battleground. The after-hours dip, though small, shows the persistent, nagging bearish pressure, but the real story is the volume and the desperate fight to hold the line above the 1.00 NASDAQ compliance level. Looking at Friday's chart, it was a classic downward drift. The stock opened at 1.07, tried to rally early, hitting 1.13 around 10:30 a.m., but that 1.13 level acted as a firm ceiling. Sellers stepped in immediately, and by noon, all the morning's gains were erased. For the rest of the afternoon, the stock just slowly bled out, chopping between 106 and 1.08. This wasn't a panic sell. There was no single piece of news that drove it down. This was a slow bleed, an erosion of confidence, which is almost more concerning. It shows a lack of buyers, a general apathy, and an environment where any significant sell order can push the price down. The volume was average, not catastrophic, but it was heavily skewed to the sell side, especially in that final hour of trading, which is what locked in that 1.08 close. This price action is happening in the shadow of one critical number, 1.00. Tilray is fighting to stay compliant with NASDAQ's minimum bid price requirement. Falling below that dollar for 30 consecutive business days triggers a delisting notice. While they aren't there yet, trading at 1.08 gives them virtually no room for error. This threat forces a sense of urgency and invites a tremendous amount of speculation, particularly from short sellers. The common belief, the market narrative that has crushed this stock from its all-time highs, is that Tilray is just another Canadian cannabis producer that overpromised and underdelivered. The entire Canadian legalization experiment has been, from an investor standpoint, a disaster. Overregulation, high taxes, a thriving illicit market, and massive overproduction led to continuous losses for almost every company in the space, including Tilray. The expectation is that this is just more of the same, but the reality, when you look past the stock chart, is that Tilray is arguably not even a cannabis company in the traditional sense anymore. CEO Irwin Simon has been very clear, Tilray is a consumer packaged goods company. This is the disconnect. Investors are still pricing it based on the failing Canadian market and the stalled U.S. legalization hopes, while the company is desperately trying to become a CPG giant that just happens to be waiting for cannabis legalization as an additional growth lever. So what does Tilray actually do now? Its operations are split. Yes, it still has a large Canadian cannabis segment, which is struggling for profitability, but holds a significant market share. More importantly, it has a strong international medical cannabis footprint, particularly in Germany, where it is a dominant player. This is a key asset. But the big strategic pivot has been into the United States, where it cannot legally touch the plant. Instead, it has spent hundreds of millions of dollars acquiring beverage companies. This includes Sweetwater Brewing, Montauk Brewing, Breckenridge Distillery, and others. The strategy is to build a massive, profitable CPG beverage and wellness business. They also own Manitoba Harvest, a hemp food company, that already has distribution channels and brand recognition across the U.S. The idea is that when federal legalization finally happens, Tilray can drop in its THC products into this existing established network overnight. It's a Trojan horse strategy. The question investors are wrestling with is this a brilliant long-term play, or is it a costly, desperate attempt at diversification that is burning cash while they wait for a political miracle? Now, we have to talk about the other side of the trade, because a stock this low, with this much frustration, is a prime target for short sellers. The short thesis isn't complicated. The company is burning cash, it has a significant debt load over $600 million, shareholder equity is eroding, and the timeline for U.S. legalization is perpetually next year. Short interest in Tilray remains stubbornly high, often fluctuating between 12 and 18% of the free float. This isn't just retail bears. Institutional money is betting against this recovery. They see the beverage acquisitions as expensive and poorly timed, acquisitions made in a craft beer market that itself is facing headwinds. The shorts are betting that Tilray cannot achieve profitability in its new segments fast enough to service its debt and will be forced into either more toxic dilution, selling shares at these low prices, or a value-destroying reverse stock split to regain NASDAQ compliance. What's your take on the rising short interest? Smart money or manipulation? This is a critical question for anyone holding the bag. As an investor, you need to know how to track this. You can find short interest data published by NASDAQ twice a month. You can also look at data from financial terminals or specialized services that track borrow rates. The borrow rate is the fee shorts must pay to borrow shares to sell. When this rate spikes, it means shares are becoming scarce, and the cost to bet against the stock is rising. Another metric to watch is days to cover, which estimates how many days it would take for all short sellers to buy back their shares based on average trading volume. A high number, say over 5 days, can sometimes precede a short squeeze if good news hits, but it also shows deep entrenched conviction from the shorts. Right now, the shorts are clearly in control, pointing to the PE ratio, which is non-existent because the company isn't profitable, and the 52-week range of 0.35 to 2.32 as proof of its volatility and failure to hold gains. This brings us to the retail investor. If you browse any forum dedicated to this stock, you see an incredible level of frustration. Many investors who bought in during the 2021 hype are now down 90% or more. There are constant calls for management to do something about the short sellers or to initiate a share buyback. But a company with Tilray's cash flow and debt issues can't afford a meaningful buyback. This creates a feedback loop. The price drops, retail gets angry, shorts get more confident, and more buyers sit on the sidelines. The Tilray long community is essentially waiting for a miracle catalyst to break the cycle. Looking forward, the entire investment case hinges on a few key catalysts. The most obvious one, and the one that everyone talks about, is U.S. federal action. The recent talk about rescheduling cannabis from Schedule 1 to Schedule 3 is a massive development. But let's be clear about what it does and doesn't do. It would not make cannabis federally legal for recreational use. It would acknowledge its medical benefits and lower the regulatory burden. Crucially, it would alleviate the 280E tax burden on U.S.-based multi-state operators, allowing them to deduct normal business expenses and potentially become wildly profitable overnight. For Tilray, a Canadian company, the direct benefit is smaller, but the indirect benefit is huge. It would open up U.S. capital markets, allow multi-state operators to list on major exchanges, and normalize the entire industry, making it easier for Tilray to secure banking and financing for its U.S. CPG operations. It would also be seen as the first major domino to fall, a sign that full legalization is inevitable. The second major catalyst is Germany. Germany's plan to decriminalize and eventually create a legal commercial market is slowly moving forward. As a market leader in German medical cannabis, Tilray is positioned perfectly to capture a significant share of that market, which could be the largest in Europe. This is a more tangible, near-term catalyst than U.S. legalization. The third catalyst is simply execution. Tilray has to prove that its beverage strategy is working. The next earnings report will be critical. Investors don't just want to see positive adjusted EBITDA, they need to see real organic growth in the beverage segment and better margins. The risks, however, are just as large. The primary risk is dilution and compliance. If the stock price doesn't recover and they can't stay compliant, a reverse stock split is almost inevitable. While this technically doesn't change the value of the company, it is almost always seen as a sign of weakness and often leads to further selling. And then there's the debt. That debt load is a clock ticking in the background. They have to generate enough cash flow to service it, or they will be forced to refinance at potentially much higher interest rates, further crippling their ability to invest in growth. It's a race against time. Comment below if you think federal U.S. legalization will happen before 2027, or if it's still a decade away. So as we wrap this up, let's return to that expectation versus reality. The expectation, seeing that 1.08 closing price, is a company on the brink of irrelevance, another failed cannabis dream. The reality is a company in the middle of a high-stakes, incredibly expensive pivot, betting its entire future on a regulatory map that hasn't been drawn yet. The stock price today reflects the market's complete lack of faith in the timing of that pivot. The market is saying you will run out of time and money before legalization saves you. The bull case is that the market is wrong, that the CPG business is strong enough to build a foundation, and that the German and U.S. legal dominoes are closer to falling than anyone thinks. The fight isn't just about cannabis anymore. It's about survival, brand building, and financial discipline. And at 1.08, the market has priced it for failure, offering a high-risk, high-reward